for joining us with that. Now I'm going to hand it across to Ekta Batra. She's got the Vice Chairman and Managing Director of Indiabulls Housing Finance, Gagan Banga. He's going to be talking to us about the second quarter earnings. Over to you, Ekta.
Hi, thanks Nayantara for that. Mr. Banga, hi, thanks very much for joining in this evening. First, wanted to just start with your overall performance. It's been good with the NII up around 34%, profit up 24%. What's your guidance in terms of the remaining part of the fiscal?
Yeah, so we'd guided at the start of the year that we will grow business across all financial parameters between 20 and 25%. If we look at the first half of the second quarter, all numbers in terms of profits, etc., are in the range of 22 to 24%. And my sense is that we should land up with profits at the higher end of the range, which is closer to 25 than to 20. So, but we will stick to the guided range of 20 to 25% for profits.
And what do you envisage in terms of loan growth?
Yeah, so the overall book growth should be in the range of 25 to 27%, and that should result in a net interest income growth of a similar number, which is 25 to 26%. The company did the closure of a very successful equity launch, so we have the growth capital for it. Our net worth is now approximately 11,000 crores. We are also benefiting from a changing borrowing mix, and as bonds become a more prevalent source of monies for us. For example, in the last 6 months, we've actually reduced our bank borrowings. Over the last 1 year, over 70% of our monies have come from bonds. That is resulting in the cost of funds coming down much faster than the actual effective market rates for the lending that we've been doing, and is causing spread expansion. We've also been able to reduce our cost-income ratios by almost 170 basis points in the first half, and for the full year I expect this number to be very close to 150 basis points, and our credit costs are also down 10 basis points. So as a combination of reduced cost of borrowings, falling cost-income ratio, and reducing credit costs, I am reasonably sure that the return on asset will grow for the full year by about 20-25 basis points, and which should result in profits also growing at the range of approximately 24-25%, and NII growing by 25-26%.
Okay, so that's your guidance. Just a quick last word then on from my side in terms of the gross NPLs. You expect it to continue at the 0.8% mark, and also what were the spreads this quarter?
Yeah, so spreads have remained steady at just over 300 basis points. We have been guiding for a while that spreads will remain in the range of 300 to 330 basis points. A lot of the savings that we are doing, we are transmitting that as far as the loan book is concerned by focusing harder on the home loan portion. So spreads should remain steady at about 300 basis points, and gross NPLs for the last 4 years have stayed in the range of 70 to 90 basis points. Net NPLs have stayed in the range of 30 to 50 basis points, and I do not see this range getting busted on the higher side in the foreseeable future. So reasonably comfortable with 80-85 bips of gross NPLs.
Okay. All right. Fair enough, Mr. Banga. Nayantara, over to you.
Mr. Banga, I just had a quick question for you. I see you're not changing your guidance at all. So would that mean you're not at all enthused by the Reserve Bank's latest attempt to provide a booster shot to housing loans by reducing the risk weightage?
No, I'm actually very enthused. Fortunately for our stakeholders, we are already sitting on a position where our capital adequacy ratio is very, very high, and we've raised this capital that we did in September to make sure that there is a strategic shift in our borrowing mix. We are able to regulate the supply of our bond borrowings and thereby reduce our costs. So I'm extremely confident of not only this 20 to 25% growth being sustained, but the steps we are taking is to make sure that for the next 3 to 4 years we are continuing to grow at this 20-25% range, which is a very, very healthy number to be growing by in the Indian financial system. I am extremely encouraged. It's a very positive move. It will definitely give a boost to the overall housing sector. And what's also happened is that in the segment that we focus on, which is the below 25 lakh rupee home loan segment, because of the tax stops that the government gives, a 9.6% home loan, which is the home loan rate that we offer at, actually becomes 4.6%. So today, and rental yields in India are at about 3%. So over the course of the last 1.5 years, the gap between rental yields and effective mortgage yields for this segment has halved. It was about 3%, it is now about 1.5%. Now this, from an affordability perspective, is the single biggest needle mover. And after being very circumspect about real estate demand, I am now finally coming to a stage where I see that at least in the 15 to 75 lakh rupee home loan segment, the growth rates will actually pick up. They've been sustaining at about 18% for the last 3 years. I think for the overall market, you will see the growth rates increasing to 20%, and we will grow a bit faster. But the company is also trying to achieve more long-term strategic objectives. Stability is our core area of focus. For that, our emphasis on home loans is increasing. Home loans on a relative basis is a slightly lower spread business. Therefore, we stick to our guidance of 20 to 25%, with the hope that this will become less a 1-year guidance, more a 5-year guidance.
Okay, Mr. Banga, we're going to leave it at that. Thanks a lot for joining us here on CNBC TV-18. With that, we have to take a short commercial break. On the other side, we're told you first, and now